All right, now to our first conversations. See, tensions over the Ukraine-Russia crisis have been simmering for more than 2 months, with the diplomatic efforts to resolve the issue showing little sign of progress, even with mounting global pressure. Let's discuss possible impact on emerging economies with Moshokwe Aruba, Economists, IC Group. Joining us on Business Morning. Great to have you. Good morning.
Good morning, Laddie. Great to join you.
Yeah, so, there are concerns that, with Russia being a global power, it could cause, major dislocations across the world with more riveting implications for, susceptible economies like Nigeria. What are your thoughts on that?
Laddie, that's correct for most countries. The impact of the conflict on countries that do not have strategic interest in the ongoing conflict, for instance, African countries, is largely going to be economic. Russia is a commodities powerhouse and is a price maker in a number of commodities markets, including in hydrocarbons. Ukraine also plays an important role in the grains value chain. So the conflict will trigger commodity price increases across both markets. The higher commodity prices will manifest in African economies through higher inflation, weaker current and fiscal balances, and possibly a squeeze on economic growth if monetary action moves in tandem with inflationary pressure. Nigeria, for instance, exports crude oil and imports refined petroleum. We also have an unsustainable subsidy bill and are still largely import dependent for majority of our consumables. So we're likely to feel the price shock on multiple fronts. Higher crude oil prices are obviously positive for our export earnings, but also impact the landing cost of petroleum and invariably the subsidy bill. So fiscal balances will be under pressure. Higher pricing for food items in the global markets will also increase the food import bill for many African countries.
Right.
And along with higher prices at the pump for countries without fuel subsidies, will filter into consumer price. So pretty much African consumers need to brace up for more purse pinching over the next few weeks.
Yeah, time to brace up. And, but before now, it was talk about inflation, being, transitory in global economies, but, that changed.
Yeah.
And, but now there's another word being thrown around, and that's stagflation. How's that looking?
Pretty much that's a major concern. That's a major economic concern because with higher inflationary pressure, you're likely to get more tightening from monetary authorities, and with tightening comes less liquidity in the market. Cost of fund becomes more expensive. People are not able to take loans to support their businesses. Businesses that are still trying to recover from the pandemic heat that they experienced in 2020 and to some extent in 2021. So if inflationary pressures are going to be pushed higher, especially by this Russia-Ukrainian crisis, then we're likely to see more tightening. So if you probably were expecting 1 or 2 rate hikes, you should be expecting a lot more. If any country that has a more responsive central bank would probably be pricing in more rate hikes at this time, and that is not growth positive.
Right.
So we may find ourselves in a situation whereby growth is undermined just to rein in inflation.
All right, and let me take you back to oil now. We see prices are, surging, and obviously Nigeria is not, benefiting, from this. But I hear the government is vowing that we're going to ramp up production, to meet up with our quota. How realistic is that for you?
We've always been planning to ramp up production for so many years, but the truth is a lot of our challenges are more structural rather than market driven. So we have a number of reasons: policy inconsistency, lack of political will to drive market-friendly reforms, and a number of other legacy issues that is stifling inflow of investment into the oil sector especially. Look at how long it took to get the Petroleum Industry Act, and even after signing the act, the government is obviously reneging on the subsidy removal clause. So we may have the capacity to increase our output. We may have the intention to, but if fresh investment is not coming in to maintain existing oil infrastructure, explore new wells, our crude oil is likely going to continue to dwindle, just as it happened with Angola.
Right. And, another thing that's been on the decline is our foreign reserves, our external buffers. It's been trending downward. With all of this happening, what can we expect there?
I mean, so for the external reserves, yes, we have like oil trading at about 111 as at this morning. But the thing is, the accretion to reserves isn't just oil receipts. You also have inflow from remittances. You also have investment flows, which should ordinarily accrue to the external reserves. Unfortunately, we all know what's going on with remittances to the extent that the CBN has this like Naira for dollars scheme in place just to try and encourage people to come through the official channels of remittances. We also know what's going on with investment flows. There's been a drought of FDI into the country. And even FPIs now are having like a hard time trying to repatriate their funds, and the chances of them coming back when they successfully do that is probably quite slim. So with the amount of pressure we have on the demand front for FX, and probably just only one source of inflow into the reserves from oil receipts, we're still.
Hello, Mashokwe. Looks like Mashokwe is frozen there. Mashokwe, I don't know if you can still hear me. Are you there? Okay. All right. Seems we're having a glitch there with the connection there. Well, I was going to talk about most of this Ukraine-Russia crisis. If it prolongs, what happens? Most people don't expect it to stay that long, but I will try and get Moshope on later to see how we can round up the conversation. But then we'll just take a quick break. When we come back, we'll continue the conversation. That's the moment to stay with us. All right, we're back now. We're still having the conversation with Moshope Arubai, economist, right there. Moshope, we lost you the other time. I think we have you now. Welcome back. Well, I was saying, most people don't expect this war to, continue very long. But take, for instance, it prolongs, it gets even longer. How can, emerging economies, what can we do, to protect our economies at this point?
Really, there's nothing much emerging markets can do. I know that there'll be a lot of pressure on the currencies, so central banks can choose to step up to the plate and defend their currencies, sell more FX into their at their auctions, pretty much. But in terms of the markets, I mean, I feel the wind would blow off eventually. Russia is not new to aggression. It's also not new to being a catalyst for market turbulence. I know once the conflict started, we felt the heat in a number of risky assets. Some have recovered, some are yet to, and there were also some beneficiaries. For instance, cryptocurrencies seem to have surged since the conflict started. But for the capital markets, stock markets, fixed income markets, I feel over the next couple of weeks or shortly after the conflict ends, we'll see a reversal in many of the trends that we're seeing now. Typically, it takes about 1 month to about 6 months for Russia's aggression to persist on African markets, and this is data driven, not just speculative. So pretty much we may still see a bit of stocks plummet over the next few weeks as the conflict deepens, but we should all expect there to be a reversal of that trend once the wind of the conflict blows away.
Right, and I saw the market sell-offs yesterday with all the global markets like the Nasdaq, but for some reason the cryptocurrency market stayed up yesterday, and obviously they're banning Russia from SWIFT payments, but it seems cryptocurrencies are coming into play here, using it to send funds in and out of Russia. How do you see this playing out?
I mean, Russia has like a significant cryptocurrencies market. About 12% of the market is controlled by Russia. And even though they initially banned it, they must have had this whole conflict with Ukraine coming, and so there's been a reversal in the past few months on the ban, in a few draft regulation going on. So typically, you'd expect that with SWIFT's restrictions on the Russian central bank, a number of transactions will be channeled through cryptocurrencies, and the chances of that deepening over the next few weeks with more sanctions and counter sanctions being thrown around, it's a lot higher, and it's a positive for cryptocurrencies. So yes, a market as big as Russia reversing its initial ban and trying to accept cryptocurrency as a currency, just because of payments regulations that they may be subject to over the next few weeks, bodes well for cryptocurrencies. And that's probably like the only asset that I think would gain consistently in the course of this country, or the only risky asset that may gain consistently in the course of this conflict.
All right, so, talking from an investor perspective now, what would you say is the, perfect portfolio mix, at this point?
I mean, for African countries, cryptocurrency is probably not an option for us from the regulatory perspective. But I think a bit of a portfolio mix that is skewed to equities right now should do the magic. And the reason is valuations, because like before the conflict even started, we're seeing like down movements in stock prices just because treasuries were inching higher. So valuations are pretty cheap in the stock market right now. So it's a good opportunity to snap some really good value stock. So I would expect a portfolio mix skewed in favor of equities, a bit of fixed income, just so that you're also able to take part in some of the gains with the recent treasury yield rises you get. But I think over the medium term, we'll see equities still outperform whatever it is that your treasuries may be giving you at this time.
I know the Monetary Policy Committee will be meeting this month. What do you expect them to, what policies do you expect them to push this time?
Sorry, I didn't get your question.
No, I said the Monetary Policy Committee will be meeting this month. So what are you expecting from the meeting for Nigeria?
I mean, I expect them to still hold. With what we've seen going on in the global space, most central bankers are likely going to err on the side of caution at this point. No one knows how high inflation will go. I mean, for Nigeria, for instance, we've been seeing a deceleration in inflation, and also there are a lot of moving pieces at this time in terms of monetary items. So I would expect the decision at this month's MPC to be a whole, just to get more clarity on a number of things, both in the global and domestic markets.
Right. All right, Moshokbe, everybody. We'll keep tracking as everything plays out. Thank you so much, Moshokbe, everybody. Economies,
Thanks
IC
for having
Group.
me.
It was great having you on Biz this morning. Enjoy the rest of your day.
Thank you.
All right, now, next is AFEX Commodity Update.